Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, how ASC Topic 842 impacts agribusinesses. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters, Allison Long and Sara Yocum, both senior managers here at Moss Adams. Their bios and contact information are located in your webcast console for your convenience. And now I would like to turn the floor over to Allison to get the presentation started.
Fantastic, thank you, Amy. So we're going to jump right into the learning objectives. In order for you to get CPE, we do have to have these learning objectives. We're going to go over the new standard ASC 842, identify some challenges associated with the new standard, and also understand how they impact agribusiness directly. All right, before we get started, we'll go over a quick refresher of the new standard. This is a really good picture of FASB's dual model. We historically under legacy GAAP have gone over capital and operating leases. Now capital is known as finance for the most part. There's balance sheet, income statement, and cash flow implications to these leases. On the balance sheet, both finance and operating leases have a right of use asset and a lease liability. Right of use assets will be presented as non-current on your balance sheet since it is a non-financial asset. Lease liabilities will be broken out between current and non-current. On the income statement for finance leases, you'll have both amortization expense and interest expense relating to these assets and liabilities. On the operating side, it'll be a single line for lease expense. On the cash flow, also slightly different for finance. You'll have any financing principal payments in the financing section, whereas all the other implications will be presented in the operating section. For operating leases, all activity will be presented in the operating section for lease payments. This is kind of the lease accounting model between finance and operating lease. There are 5 criteria, and hopefully the first 4 look familiar to you. They are all kind of brought over substantially from legacy GAAP. The fifth criterion on here is relating to an asset that is specialized in nature and only lessees can use it without major modifications. That is another criteria that if you meet that, it can be classified or should be classified as a finance lease as opposed to an operating lease. If none of these criteria are met, then they fall into the operating lease category. And then last but not least, the transition and effective dates. The biggest point here is we really cannot push it back any further. The new standard is here for non-public business entities. If you're a calendar year end, you are required to adopt effective 1/1/22. So we are in that crunch time now, and hopefully you've thought about this new standard recently and started implementing, but we'll go over a few key points throughout this presentation. And I will pass it over to Sara for some transition details.
Welcome. I'm glad to be here, and we'll talk through now some transition details. So let's go forward. Allison mentioned that the adoption is here. If you're a calendar year-end entity, you got to adopt for your 2022 fiscal year. If you're not a calendar year-end entity, you're still probably starting to think about or work on adopting, but you fortunately get just a hair longer to adopt, so that's great. Really in the standard though, what we want to point out as we think about transition methods is that the standard writers have given quite a bit of room to try to make this process as easy as possible for you. I would air quote easy because I still don't think it's simple, but they've tried to simplify it. So let's just talk through a few of these. Really what we should thank them for is most of the time when we see a new accounting standard, you have a requirement to adopt it and show from a presentation standpoint in your financial statements any period that's presented in your financial statements. One of the transition methods they are allowing for ASC 842 is called a modified retrospective approach, which is really allowing you to adopt as of and apply the standard as of 1/1/22. That means if you present a 2-year comparative financial statement, your 2021 financials will still be under ASC 840. And your 2022 financials will be under ASC 842. So you will have a little bit of a lack of comparability. That lack of comparability on the face of the financial statements will be addressed in some additional footnote disclosures, but it does allow for a faster adoption process because you're not having to go back and analyze multiple periods. They also allowed for certain practical expediencies within the standard to allow and make it easier for adoption. And that these really fall into a few different packages, but we're going to talk first about this package of 3. And the reason we're going to call it the package of 3 practical expedients is because you have to adopt all 3. You cannot adopt just one of them to get any of them. So it's an all or nothing package. And really the 3 practical expedients allow you to not reassess whether an expired or existing contract contains a lease. As we'll talk about a little bit more in depth later on, there are times when agreements that we have in our organizations have leases embedded in them under the new lease standards. And you don't need to go back and assess whether or not those do exist or have, or if you have any expired leases. You also do not have to go through the exercise of documenting or reassessing whether each of your leases is classified appropriately as a finance lease or an operating lease. You get to use the presumption that you did that right the first time and that they will just be changed from capital leases to financing leases, and then really your operating leases will come onto your balance sheet as right-of-use assets and right-of-use liabilities. The third of the package of 3 is you don't have to reassess initial direct costs for any of your existing leases. Most of the companies we've seen or talked with are electing this package of 3, as it does help expedite the process. But just know if you do, there are some additional disclosures that you need to. And then the other piece I want to make sure I point out is if there was an error in how you assessed a prior year lease as far as classification goes, it doesn't stop you from needing to like call it out and analyze that error. So for example, if you called a lease a operating lease, but it was very clearly, it had a dollar bargain purchase and very clearly should have been a capital lease, and it was a significant material lease, we would need to reassess that before applying these practical expedients. Some pros and cons is really, you don't have to go through and reevaluate all of the leases, right? You get to make some broad assumptions that you did the analysis correctly, that they're going to come on the balance sheet if they're operating leases. But really what that does is it means you don't have to go back and evaluate for existing and expired leases. That's a big time saver because you don't have to go search through every single one of your agreements to find out if you've got an embedded lease. A lot of times we can look at revenue agreements where there could potentially be an embedded lease, or different purchase agreements where there's something embedded. Not electing the package is an option, and some companies do take that option. It does require a lot more work, but it typically can be advantageous if they think there's classification changes that they could benefit from. Another practical expedient offered by the FASB was use of hindsight. And what this practical expedient does is it allows you to analyze the lease term based on hindsight, so what you already know. And we're going to look at an example in just a minute. But basically, you have to treat 1/1/2022 as the effective date or commencement date for all of your leases when calculating the present value of future minimum payments. And what that means is you can think at that point if the term that you would have assigned originally is still accurate, or if you now know something has changed where you may or may not renew the lease. So we will move into the example now because I think it helps clarify this piece of the transition practical expedient. So here's our example. On January 1st, 2021, the lessee enters a 2-year lease of a tractor with an option to extend for another 3 years. The lease is classified as operating and the lease renewal isn't reasonably assured. Due to events outside of the lessee's control, as of the effective date of ASC 842, so January 1st, 2022, it's reasonably certain that the lessee will exercise the 3-year renewal. So if I was doing this analysis under the old lease standard, under ASC 840, I would have said, hey, I've got a 2-year lease. That's my lease term. And if I was doing this analysis, but because at January 1st, 2022, I'm very confident that I will actually exercise the 3-year renewal, what I need to do is include that 3-year renewal in my number of periods that I'm using to calculate my present value of the lease. And so for that to be how you look at it, you have to elect the hindsight practical expedient. If you didn't elect the hindsight practical expedient, you would actually only use the 2-year initial term because that was how you would actually view it. So when you adopt at 1/1/22, you'd only have 1 year remaining. The other thing I'd like to point out is really that the hindsight practical expedient, you can adopt that whether or not you adopt the package of 3. That is a separate practical expedient that you're able to determine if you want to elect. So let's look at just a few more examples to highlight kind of the transition of capital to finance lease. So I'm going to read the example and then we'll talk through what it does to the balances. So prior to the adoption of 842, the company enters a 7-year lease of an asset with annual lease payments of $25,000. Leasing included a residual value guarantee of $8,190. The company's incremental borrowing rate on the date of commencement was 6%, and the company classified the lease as a capital lease. The company also had initial direct costs of $2,800, which is deferred and amortizing over the lease term. So as a capital lease, the ending balances on December 31st, 2021 are really the lease liability of $128,707. If you guys feel the need to redo the math on that, be my guest, but we're not going to do that right here. The lease asset is $124,434, and you'll remember that with capital leases, they're depreciated over their life. The assets depreciate over their life, but the expense tends to be front-loaded. Unamortized initial direct costs of $2,400. So that's your ending balances before we have to adopt. So if we adopt the practical expedients, really our only change in our balances is that our unamortized initial direct costs are going to be added to the value of the lease asset. So you can see where that really simplifies adoption from a capital lease perspective, transitioning from capital to financing. We're just moving the unamortized piece up into the lease asset because under 842, it is part of the initial value calculation of the asset. So let's also talk about a similar example, but of an operating lease. So we've got a 5-year lease. It starts in January of 21. It has annual lease payments due at the end of each year. Remaining payments are $31,000 due in 22, $33,000 due in each of the years 23 through 25. And the company classified the lease as operating, which I already said. And then we had initial direct costs of $500, which is deferred and amortizing over the term. So under that example, remember with operating leases, we add up all the payments and then we recognize it straight line to expense. So each month you're deferring under 840 a part of the expense to straight line, or a part of the payment to straight line the expense. And so we've got deferred rent of $1,200 and unamortized initial direct costs of $400. And then to transition to the operating lease, we're going to say, yes, they have a package, they're going to apply the package of 3. We do not need to reassess classification because we adopted the package of 3, so it will still be an operating lease. However, we do need to calculate the present value of the future minimum payments to be able to record the right of use asset and the right of use liability as of January 1, 2022. So for that purpose, we're going to use the company's incremental borrowing rate, which is 6%. And when we do that, what you can see is our deferred rent goes to 0. Our unamortized initial direct cost goes to 0. And then we have a lease asset of $111,662, which is really a combination of the lease liability, which is the present value of the remaining lease payments at the discounted percent, or the rate of 6%, right? And then you can see the math, the 112 less the deferred rent plus the the unamortized initial direct cost gets you to your lease asset. So in this instance, the difference in these amounts is going to end up getting posted as a beginning balance adjustment to reduce these other two assets. So as you can see, when you just look high level at the transition calculations, there's a fair amount of work. And so what we wanted to do is really think about, how do we approach this from a big picture? What's the plan? And so really we've broken that out into 3 phases. Hopefully, if you're on this webcast, it's not because you haven't started yet, or if you haven't started, you don't have a ton of leases. But if you haven't, really we want, you really have to start soon. I would encourage that. But 2, I would think through kind of the phases. So planning is just identifying what contracts you have, what leases are out there, and moving forward from there. Phase 2 is assessment, financial impacts stuff. So that's doing the calculations, right? And so there are softwares out there you can use, but it's doing the calculations, getting the entries developed, making sure you've reviewed those entries, and then really preparing the disclosures. But most important, and what I want to make sure is pointed out on this presentation, is this is an ongoing standard. You're not done. Allison's going to talk about a little bit more in detail later, concepts of lease modifications or different things, but our environment's constantly changing, whether the economic environment's changing, the specific market you're in, your company, the strategy going forward. These are all things that are very dynamic and change over time, and they impact what you're doing with your leases. And so what I want to point out is really you need to have good controls or a plan in place to monitor the leases going forward, to think about, is there a significant change that would cause me to need to revalue this lease on my balance sheet? And then we're not going to talk in a ton of detail about this slide, but we did want to include it, just a few places for you guys to think about where leases could be hiding that you may not think of as leases that really are leases. But remember, if you adopt the set of 3 practical expedients, you don't have to go through this step of going and finding them all. So, all right, with that, I'm going to turn it back to Allison to dig in a little deeper on some of the key concepts.
Perfect. Thanks, Sarah. So we're going to dive a little bit deeper into a couple concepts that we really want to hit hard and make sure that you guys fully understand the implications, because they have historically not necessarily been used under legacy GAAP under 840. The first one is the discount rate. So there are 3 discount rates that are acceptable under ASC 842. There's the rate implicit in the lease, the incremental borrowing rate, and the risk-free rate. So the rate implicit in the lease, if it is stated in the contract, the agreement, it is required to be used. You don't have any other options. That is the rate. It is given to you. And that can be one of 2 ways. It is just a stated rate, or if you are given all the facts and circumstances where you can back into the rate that is being used, you are required to use that rate. Now, if you don't fall into that category, you generally have 2 options: the incremental borrowing rate or the risk-free rate if you are a non-public business entity. So if you're a non-public business entity, you do have 2 options here: the incremental borrowing rate, which we'll go over on the next slide in a little bit more detail, or the risk-free rate. The risk-free rate is, obtained on the treasury.gov website. I will say most of my clients that I've assisted with implementation or have been working with are not using the risk-free rate. Generally speaking, it is going to increase your right-of-use asset and your lease liability on your balance sheet. There are implications to that. There's some working capital, any covenants that you may have that might change the results of those covenants. So risk-free rate, I would hesitate, think about the implications before just adopting the risk-free rate across the board. The incremental rate is actually what I'm seeing most of my clients use. Sarah, I think, is that what you're seeing as well on your side? Yeah.
Yeah, that's fair.
So with that being said, let's go into the incremental borrowing rate. So this is the rate that you would pay, a lessee would pay for a similar asset, similar currency, similar term, generally similar just terms all around in the agreement. So if you constantly lend for similar assets and there's rates you're using there, you can use that. If you are a client who has not traditionally borrowed money or have financed similar assets, then you might need to do a little bit more work here. That might be reaching out either to some colleagues at other entities. Reaching out to a lender is usually one of the first suggestions I personally make, see what they're seeing in the market. So this piece is huge because there is significant judgment involved. This needs to be documented in a memo, in your implementation memo and ongoing. There are some practical expedients, which we're going to hit on here shortly as well, relating to this. But the borrowing rate, not only does it affect your right-of-use asset and lease liability calculations, but it does affect covenants and financials down the road that you want to be cognizant of before just blindly going and picking a rate. So here's a practical expedient that can be adopted. You can adopt a single discount rate for a portfolio of leases, whether that be equipment leases, building leases, etc. And you can apply that rate across that entire portfolio. The caveat there is that you need to conclude that it doesn't create a material difference if you were to use an individualized rate for each of those contracts. The only way to know that is to somewhat go through that exercise. We need to document all of that analysis that you can basically support your opinion why this is not going to materially affect any balances on in your financial statements. I will say, I would probably say 50-50 on my clients that are using this practical expedient. Some of them feel it is easier just to go one by one, but I have a few clients that do have large portfolios of, say, tractor leases that are very similar in terms, and it's just easier to adopt that. And they have proven out and done the analysis that it's not going to materially affect the balance sheet. With that, Amy, I will move it over to you for the first quiz question.
All right, thank you. So yes, our first question is, what discount rate is your company most likely going to use? A, rate implicit on lease agreement. B, incremental borrowing rate. C, risk-free rate. Or D, not sure, haven't thought about it yet. And the polling questions are located right on your slide, so please make sure you have that window open. And then to respond, you're going to click the button next to the answer you choose and hit submit. And if you can't see the submit button, you're going to need to enlarge your slide area.
And so while that's open, like I said before, I think most of my clients are using the incremental borrowing rate. If the rate is not already implicit in the lease, that is key. You don't really have an option otherwise. But I'm not seeing many clients use the risk-free rate for those reasons I stated before. Sarah, same situation?
Yeah, no, I'm in the same situation. Typically, if it's not implicitly stated, which there's not a ton where they implicitly state it, we're going down the route of the incremental borrowing rate.
Yep.
All right, here are the results.
Okay, decent spread here. For those that haven't thought about it yet, hopefully you're thinking about it now. Just remember those three. I think that one slide that really details each of the three rates is going to be key for you. Again, implicit in the rate or implicit in the agreement, have to use that. Otherwise, you do have two options as long as you're a non-public business entity. There we go. Okay, so now lease payments. So historically under 840, lease payments were fairly simple. You pay $50,000 a year annually and you have your lease payments. However, now there's a lot more consideration that goes into what are those payments. You can have fixed payments, you can have variable payments, there's payments for penalties if you're reasonably certain you're going to terminate. There's fees paid for structuring the transaction. And there's also some amounts under residual value guarantees, which we won't get too much into today. But with fixed payments, this can include any incentives paid. We really need to holistically look at any kind of money flowing around either direction into the lease payments to determine what should be included and what shouldn't. And this reasonably certain threshold is really going to come into play on a lot of these determinations. So we'll dive a little bit deeper into variable lease payments. So there's kind of two common examples of variable lease payments. Rents that are charged on an index like the CPI, maybe LIBOR, et cetera, or payments that are contingent on achieving sales. This might be like a crop share agreement. These are super common in the agribusiness world, so we really want to hit on that piece of it and understand what's the proper treatment. Generally, these are accounted for as period expenses. The increase is not included in your lease liability or your right-of-use asset. You use the rate at the commencement date. So if as of 1/1/22 you're adopting, that is the rate, that is the time period that you are going to use that rate at that point. Even if the rate increases or decreases down the road, you are not changing your right-of-use asset or lease liability necessarily unless we get to a lease modification, which we'll talk about a little bit later. That Sara will go over a little bit more with agribusiness for crop share agreement. So I'm just going to leave this here, but know that variable lease payments do need to be considered. They may or may not be included when calculating the right-of-use asset and lease liability. Short-term lease exception. This one, I think 99.99% of my clients are going to adopt. There is a practical, or there's an election that you can make by underlying class, again, office equipment, buildings, etc., where you do not apply 842 to your short-term leases. Short-term leases are defined as 12 months or less, and that is at the commencement date, not necessarily if you're adopting as of 1/1/22 and you only have 1 year left. That is technically still a longer term if it started pre-842 implementation. The other piece that I actually want the big takeaway from this slide is month-to-month leases do not automatically make them short-term. Because of what, we'll talk about lease term in a minute, but lease term is kind of a new notion that we have to consider. Just because it is a month-to-month lease doesn't mean it's automatically short-term. You need to consider, are you reasonably certain to exercise, that? Are you going to continue that? How long have you had that lease? If you're going into 842 adoption and you've had this month-to-month lease for 5 years, maybe it's essential to your business, this is probably not going to fall under the short-term lease exemption. Another one that kind of falls in there are usually related party leases. You may or may not have formal agreements written up with those, and they are probably a month-to-month agreement. And we really need to consider those. Are they longer term? Look in hindsight, have you had them? How many years have you had them? Do you need them going forward? Are they essential to your business? So yeah, short-term lease exemption, if 12 months or less, similar to 840, you usually kind of excluded those. We really need to make sure we're properly identifying them at implementation. So that goes right into the lease term. This is where it is different, where renewal and termination options are included. So if you have a 5-year lease with a 3-year renewal option, we need to really sit back and consider, are we reasonably certain to exercise that extension, where before you probably did not. Here's a couple examples that you want to consider with the lease term: options to extend, option to terminate if you're reasonably certain to terminate or not exercise that option, and then periods covered by an option to extend or not terminate. that is controlled by the lessor. If it is controlled by the lessor, it needs to be included in your analysis. So these are a few lease term considerations that you probably didn't consider before under 840, but are definitely in the standard and required to be considered. So this moves into our reasonably certain threshold. So in typical FASB they do not define reasonably certain. They're not going to. However, based on historical knowledge, some other guidance, it's generally implied to be 75 to 80%. So if you are 75% sure you are going to renew your option to extend for 3 years, that should be included in your lease term and your calculation for the right of use asset and lease liability. There are also other factors that go into it, is whether the purpose or location of the asset is unique. Would it be difficult to go out there and find another asset to replace that? If so, you're probably going to renew or take that renewal option. The cost to operations. If you could go get another one, but the cost of taking it out and putting another one in is substantial, it's probably reasonably certain that you're going to just stick with what you have. There's also contractual terms, the importance to the operations, and there's also tax consequences that you might need to consider. So all of these need to go into consideration and be documented of your reasonably certain threshold going forward. Again, 75 to 80%, there's no hard line. Reasonably certain is key here when it comes to determining the lease term. And with that, we're going to go into a good example of this. So Amy, I'll let you take it away.
All right, thank you. So our second polling question, you're going to want to read the scenario listed there and let us know what the lease term is. Is it 10, 15, 20, or 30? And it's okay if you get the wrong answer, you still get credit. We'll leave this up 30 seconds or so to let you read through it. All right, quite a few responses are coming through, so we'll do another 5 seconds here. All right, and here are the results.
Perfect. Yep, so the correct answer is D, 30 years. As you can see, Alex enters into a 10-year lease for land, and there's an option to extend. So the company then needs to assess, whether or not are they reasonably certain that they're going to extend. Because they are constructing a building on the land, it's probably highly unlikely that they're going to terminate, and it's reasonably certain that they're going to extend because of this construction of the building. And so because the estimated life is 30, so they have an original 10-year contract with a 20-year extension, they're likely going to have that 30-year. They're going to exercise the option to extend, and it'll be over 30 years. So you would calculate your right of use assets and lease liability with using that 30-year mark. And so with that, I will pass it over to Sara to go into our agribusiness challenges.
Yeah. So let's dig a little deeper into some areas that really have a big impact on agribusiness. And from what we've seen in working with our clients, really there's 3 challenges. And I won't say these are the only challenges, these are just the biggest 3 challenges we see. And those are really variable lease consideration, leases that contain land, and then biological assets. So we'll talk about each of those, and we will talk in some detail just to think through what we need to be thinking about when we think of these different things. So Allison did a great job covering what is variable consideration, and these are really payments that are going to change based on some variable that we may or may not know or be able to control, right? And so for this example, let's just talk through the example. Agri LLC leases an almond orchard from Almond Company. We're accountants. We're very creative with our naming of things. Definitely not my top priority, but so you'll see how creative I got. Lease payments include $300,000 per year for 5 years, plus 30% of the orchard's net proceeds. Now, in this example, when we think about how do we determine the payments, we've really got two pieces, right? We've got known payment that we're making. So the $300,000 per year for each of the 5 years is a known fixed payment. We know the payment, we know how, when, where, all of those things. But what we don't know is what are my net proceeds for that orchard going to be? Do I know what kind of water supply I'm going to have for the next 5 years? Do I know how hot it's going to be, when it's going to rain, when it's not? I don't know any of these things that are going to potentially drive the yield from the orchards, let alone the market pricing. We've seen in different crops do very big swings quite quickly in the past couple of years. And so in this instance, we will calculate our right of use asset and liability based on the fixed known payments. And then as we make the variable payments that are based on the 30% of the net proceeds, we will expense those really as when the crop is sold and the net proceeds are determinable. The second kind of unique, or I wouldn't say unique to agribusiness, but more complicated area or challenge for agribusiness is we really have to think about our leases that contain land, which is a lot of them. ASC 842 requires a separate evaluation of leases of land, whether that lease is explicit or implicit. So what that means is if I have a lease of an almond orchard, and that's what my lease agreement states, I'm leasing trees and I'm also leasing land that the trees are on, plus probably the irrigation equipment and some other things, right? But to really think about this, we want to understand just a little bit more about how the lease standard is structured, and it really wants you to break the lease out into components. And under ASC 842, there's both lease components and non-lease components. Land would qualify as a lease component and likely needs to be a separate lease component from the trees if we think it's significant. And if we need to, and in doing that, what the standard says is really that we need to allocate the pricing of the land or allocate the cost of the lease to the different lease components. And so this can be a little cumbersome if you have a lot of land leases, right? Like if we have leases with orchards, or we have leases with multiple elements, with one of those elements being land. Oftentimes the lease doesn't say you're going to pay me so much per year for land, so much per year for orchards, so much per year for this. So it's going to add additional layers of work on our part to support what amount should be allocated to the land component versus the orchard component, or the equipment or water irrigation system component for that matter. And so what we should think about in doing this is really thinking about, does it make sense that these are separate? And there is room in the standard that says if you can't separate how you use them, you can treat them as one component and recognize it, as long as it's not a significant change. And that is often where we land in a lot of these land orchard type combinations. The third of the challenges we see in agribusiness often is accounting for biological assets. And US GAAP right now does not specifically define biological assets. I know they write standards, they don't give us all the definitions, and then we get to use our judgment to apply them. However, there is at BC 110 in the basis for conclusion to the original standards proposal update, ASC 2016-02, it does make reference to biological assets and says that it's really plants and living animals. Couple of things to think about when we think about biological assets. One, they would not be a lease component. They would actually be accounted for as a non-lease component. And they are typically grown on the land that we just said we need to be careful about how we evaluate if it's a separate lease. And so those things complicate it. There is an accounting policy out there, election that you can make as an entity to say that your non-lease components will just be treated as part of your lease component, meaning you're not going to separate them and you're not going to value them separately. And if you elect that policy, then you really are in a position where you're just going to treat them as part of the lease. This is all parts that I think ultimately, depending on how you conclude and what you reach, is going to depend heavily company by company, what makes sense to them. As sometimes when you're harvesting, if your crop is a more annual crop, you're really pulling into inventory and there's more complications behind it. However, for today, what I want you to walk away with is if you have biological assets, there's a little bit more to think about because they would be a non-lease component under the standards. Are you willing to elect the policy that says you're not separating non-lease components from your lease components? Remember, when it's an accounting policy election, it applies broadly to all of your leases, not just the one lease. So you really, if you've got other leases that have non-lease components that for some reason you wouldn't want to include in determining the value of your right of use asset and right of use liability, to Allison's point earlier, when you think about if it drives up that calculation or lowers that calculation, and it can have an impact on your working capital or different ratios from a covenant standpoint, you may need to just give it more thought before blindly making that election. With that, we are going to talk through one example. It says it's a biological example. I think it's going to be both a biological and a land example to an extent. So back to our original example, Agri leases the almond orchard from Almond Company. Lease payments are $300 per year for 5 years with the 30% of the net proceeds. As part of the lease, Agri has right to use the trees, land, and all the improvements associated with the production and maintenance of the trees, such as irrigation equipment. So what we want to think about is what are the lease components? And really we have irrigation equipment is a component, and we have land and we have trees. We're going to keep it simple to those are the three components. We could make this much more complex if we wanted. So really, as we think about it, the irrigation equipment, the trees are very dependent on this, right? Like if we don't get water to the trees, they're probably not going to grow and they're not going to produce as much fruit as we would want them to. The land, we are going to say for the purposes of our example, is not a separate lease component, as the effect would be insignificant if we accounted for it separately. And typically what that really means is whether it was separate, like we're not going to have a huge change in how we recognize the lease asset and lease liability. Then the trees, while they are really a biological asset and are its own non-lease component, so they're excluded under the lease standard, that would be our other component. So how do we allocate the consideration to the lease and non-lease components? And we're not going to break down the exact details here, but you really have two options in our mind. One is you allocate consideration to the lease and non-lease components. So that would say take your $300,000 for the 5 years and determine how much gets applied to irrigation, how much gets applied to land, and how much gets applied to the trees from a value standpoint. You would really need to take the time to document your allocation methodology, how you valued it, how you allocated it, and then you'd want to keep that well documented and supported for auditors or anybody else from a GAAP standpoint. The other option is really to elect the practical expedient that says don't separate the lease and non-lease components. And under this expedient, we have the larger right of use asset and liability, but it's a simplified application. So just know that by adopting that practical expedient, you will increase the value of your right of use asset and liability. So with that, we're going to turn it over to Allison to talk quickly through some other matters and go through the last couple of polling questions.
Perfect. Thank you, Sarah. So I know this was called Other Matters, but it's really lease modifications. So I saw a few questions kind of come in the Q&A about this, and I think this is really goes to that phase 3 that Sarah talked about early, like the ongoing monitoring of 842. You're not done once you implement. Lease modifications happen all the time. So I would be surprised if you don't come across a lease modification within the next year or so. So lease modification is really a change to the terms and conditions of the contract. Some of the most common examples are maybe an extension that wasn't built into the contract, early termination of a lease, something happened and it got terminated, change in the timing of the lease payments, or leasing an additional space in the same building. These are examples of modifications. And so what do? The first thing is, should it be identified as a separate contract? There are 2 criteria here. One, that the modification produces an additional right of use asset. Are you getting access to a new asset or more access to a new asset? And 2, are the lease payments, do they increase in line with the standalone price of that additional right of use? If those 2 items are present, then that change, I put that in air quotes, would be accounted for as a separate contract. You wouldn't modify the one that is already on your balance sheet. This would be a separate contract, and you would go through all those steps we've talked about: identify the term, recalculate, identify the discount rate, calculate the right of use asset, and lease termination. If those 2 items are not present, then the next slide shows a really good flow chart, decision tree, where you would just reassess the lease classification, so finance versus operating, remeasure the lease liability, and adjust the right of use asset. So if both those answers are no, or one of them is no, not both of them are not yes, you would just reassess and recalculate the right of use asset and lease liability that's already on your balance sheet. Now, if you had something like that, like a lease extension, it's a lease modification, didn't meet the separate contract points. At this point, if the lease is based on CPI for the rate or anything like that, you could reassess and recalculate based on the current piece right then. So that is really key. You wouldn't change your right of use asset or lease liability up until you actually have a lease modification. So at that point, if the lease modification is July 1st of 23, then at that point, if it's based on a new rate, you could change the rate in your calculation there for the new asset and liability. So I think this is a really good flow chart, simple but useful in determining if you have a separate contract or not. And then, so here's a quick example, I'm going to read through this fairly quickly. You've got a 10-year lease of office space with an option to extend an additional 5 years. Lease payments are what they are. I'll do at the beginning of each year. At commencement, the lessee concludes that it's not reasonably certain to exercise the option to extend for an additional 10 years. The rate implicit in the lease isn't readily determinable, so you use an incremental borrowing rate of 5.87%. Which is, meets all the definitions. It reflects a rate that you could find elsewhere for similar contract. It is classified as an operating lease. And so with that, here is your polling question that Amy will get started.
All right, so here's another scenario that you can read through quickly since we are low on time here, but you're going to want to say if this event results in a lease modification. You can mark yes, no, or not sure. And again, if you get it wrong, you still get credit. All right, we're going to do 5 more seconds since we're running short on time here. All right, here you go.
And so, so majority of you guys got it right. So it is yes. I'm going to move over to the next slide. So yes, the construction of the leasehold improvement is deemed significant event or significant change in the circumstances. That directly affects whether or not you're going to exercise. So this does trigger reassessment of the lease term, which will require remeasurement. And as I said before, this would take into consideration any update in your incremental borrowing rate. So since you're remeasuring, understand, is there a change in the incremental borrowing rate at that point in time? You can change it there, recalculate, and move forward. You would also need to make sure that the classification is still appropriate operating versus finance. And then the last section, we're really not going to say much about for disclosures other than they are extensive and a lot more. So Amy, here's this last polling question here so everyone can get credit.
All right, the last question is, where are you in the process to implement ASC 842? A, already fully implemented, B, partially implemented, working through a few final decisions internally, C, partially implemented, looking for a few additional guidance or some additional guidance, D, still researching and learning the new standard. And while you're responding, for those that would like a copy of today's slides, you can download them now from the folder that says slide deck and handouts. And then we're also sending them via email tomorrow along with a recording of the webcast.
And while you guys are still answering that question, again, with disclosures, they are just robust. If you recently went through 606 a few years back, as you know, for revenue recognition, all the disclosures have increased. There's quantitative and qualitative disclosures that some are, you will be familiar with, but others are a lot more robust. So definitely look at the guidance, reach out if you have questions with regard to any of that. And looks like majority are still researching, so great. So please reach out if you guys have questions on the new standard. Again, I'm going to skip through all of this information. It will be in the slide deck that you have downloaded that's in the system. If you have questions, please reach out. Those are our key points for takeaways. And last but not least, questions. So Amy, I'll pass it back over to you.
All right. Well, thank you, Sara and Allison, for a great presentation today. I also want to thank our audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer yours, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you have additional questions. Their contact information is in your console and in the slide deck that you can download If you met all CPE requirements, your certificate is available to download now in the CPE progress window. We will email that out within 2 weeks if you have difficulty downloading it now. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care.